Okay, good afternoon everybody and welcome to the latest Urban Living webinar. Today we're going to be discussing the hospitality transaction market. Now these webinars are a series which are a precursor to a new live event which we are hosting at Tobacco Dock in London on July the 7th and the 8th. It's called the Urban Living Festival and it looks at how various hospitality and real estate asset classes are converging. It's themed around three stages: live, stay and work. There'll be more information on the event in the chat panel and we hope to see lots of you there. We can't wait to get back to doing face-to-face business again. A few webinar guidelines. If you're not one of our panelists, you will be auto-muted. So if you could please keep your mute button on, that makes life a lot easier. We're going to have about a 45-minute discussion with our panel, followed by 10 to 15 minutes of Q&A at the end. If you do have any questions, please do pop them in the Q&A and we'll get around to answering as many of those as we can at the end. Everybody who's registered for the session will receive a recording via email in the next couple of days. Now this webinar, excuse me, that's me. My name's George Sell. I'm Editor-in-Chief at International Hospitality Media. We are an online publisher of B2B news sources and an event organizer. This webinar series has been sponsored by Res Harmonics, and this particular session is also sponsored by AHV Associates, of whom we shall hear more shortly. But first, here's a quick video about Res, and you can also see their contact details in the chat if you'd like to know more.
Res Harmonics is 100% dedicated to service departments and co-living, bringing together all the tools you need to drive performance and deliver a great guest experience. From channel management and direct bookings to finance, housekeeping, maintenance and customer journey automation, whether centrally or on the move, the platform consolidates all information into one system, saving you time, improving communication and maximising business performance.
Okay, so if you'd like to hear more about Res Harmonics, the web address is in the chat there. Before we get started, I just wanted to give the conversation a bit of context and see what actually has been going on. So we have three B2B news sites, one for the service department sector, one for boutique hotels, and one for the short-term rental space. And I've just taken a few recent screen grabs from stories that we've run from each of them, just to show you the kind of things that have been going on despite the pandemic. So these are all from service department news. Most of them are from the last couple of months. So here in the UK, we've had the Aberdeen and Room 2 sale and leaseback deal. We've seen Ascot making the first move into the US student accommodation market, which is an interesting one. And then just last week, AKA has formed a joint venture to launch a 500 million hotel fund, and they're looking at properties mainly across the US, but also in London. On the boutique hotel news side, you can see again a reasonable volume of transactions, and there's a range of them. There's single assets, small portfolios, and small hotel groups too. And on the short-term rentals side, again, a fair bit of activity. Mainly on the property management side, but one particularly intriguing one, perhaps not the most relevant for this session, but an intriguing one nonetheless, was Wyndham Destinations, a big timeshare company, has actually bought a media brand, Travel and Leisure, and is rebranding itself as Travel and Leisure rather than Wyndham. So that will be an interesting one to follow. So we've got a great panel with us today. I'm going to ask the guys to all introduce themselves, and I'm going to go from left to right as they are on the slide. So Giovanni, if you'd like to kick off, please.
Hi, everyone. I'm Giovanni Forni. I work with Cedar Capital. Cedar Capital, maybe a little bit of background. We're operating partners, have invested about 3.5 billion euros in hospitality real estate since Cedar has been set up in 2004. I've been with the company for 7 years, and we've got offices in London and New York. so active mainly in Europe, key cities and resort destinations. Same over in the US.
Thanks, Giovanni. George, welcome to you.
Hi, good afternoon, everyone. George Panayiotou, Panayiotou Capital. We are opportunistic hotel, real estate backed, private equity family office, looking at mainly the UK for rebranding, repositioning and repurposing hotel assets.
Thanks, George. And Jeremy, over to you.
Many thanks. Good afternoon, everybody. My name is Jeremy Jones. I'm head of the hotels brokerage team at Christie & Co. We're a heavily regionalised and central London advisory firm, busy in the private hotel brokerage space. It's my 25th year with the company. I'm showing my age, but it's a period when I've sold all shapes and sizes of hotels.
Thanks, Jeremy. Andrew. Andrew, are you there? I think you might be on mute.
Can you guys hear me?
Yes.
Good. Yeah, Andrew Harrington at AHV, delighted to sponsor this particular webinar. Thank you to George, to you and Piers and all your team for what you've done in the last year. It's been much appreciated by everybody in the industry. AHV is my company. 20 years ago, I started up, had 10 years at a big investment bank prior to that. And we advise on mergers and acquisitions and capital raising, an investment banking boutique, just for privately owned businesses around Europe, with speciality in hospitality. We also do every 6 months or so a piece of research, which we distribute widely. And we've recently started a monthly publication, which has trading performance of all the public hotel companies, key hospitality news, macro and capital market snapshot, recent transaction activity, etc. It's free to sign up. It's free to get. Sign up on www.ahvassociates.com. Maybe Justin can put our website on the chat. That'd be great.
Thank you, Andrew. Very slick. And last but not least, Jeff, who we just snuck in at the last minute, like a star signing before the transfer window closed. So welcome, Jeff. Good to have you here.
Thank you, George. I hope I get the same salary package as a star signing. Just want to introduce myself as one of the founding partners of Limestone Capital. We're an asset management company out of Switzerland. We have our own brand, which we primarily focus on assets that we can reposition to our own brand, which is Aethos Hotels and Clubs. We are focused at the moment in Portugal, Spain, and Italy, and we'll expand out of there as the future goes.
Thanks, Jeff. You can see the LinkedIn details for all our panelists in the chat. So if you'd like to make contact with them and carry on the conversation after the session, then please do. Okay, so obviously the last year or so has been an unprecedented period for the hospitality industry, but what is the level of currently available assets compared with a quote unquote normal year? Jeremy, would you like to kick off with that one?
Sure, thanks, George. Just briefly looking back to last year, 2020, there certainly was a limit in terms of supply coming to market, and we were seeing lower stock levels. No doubt the banks working with more and more of the hotel owner groups, processing CBILS loans in the various forms of lockdown, and that meant there was less stock coming to market. Coming into 2021, Q1, we can see substantially more opportunities, both single asset and portfolio. We did a quick tot up before. We're over the £1 billion mark in terms of regional UK portfolios and large single assets in London coming to the market. In respect of the base business at Christie & Co, where we have regional entrepreneurs, it's interesting to note that right up until the 10th of March today, we've exchanged on 105 hospitality businesses. That's 2.5 times more businesses than we sold in 19 and twice as many as we sold in 20. So that regional entrepreneurs backing themselves, writing their own checks to buy hospitality businesses is busy. But now I think we're starting to see those bigger opportunities the capital has been waiting for.
Thanks, Jeremy. Jeff, you're currently in the process of closing, I think, on 2 hotel transactions. So you're putting a portfolio together. How are you finding the level of stock available at the moment?
Well, we, along with a lot of other, I think, investors in the market, were expecting the market to be more open and also have a lot more opportunities at the end of last year. We found out, though, that I think it was mostly based on government stimulus, that there wasn't as many opportunities that people were hoping for. I would actually rather say that it wasn't a bloodbath. What it was that there was a lot of selective deals available that you could go in, and if you were quite innovative, you could leverage these deals with creative financing and creative partnerships to make them happen. And I think what it required the investors to have a little bit more vision and to be a little bit more open than normal, instead of just sitting back and just hoping these things would fall out of the sky. And I would say already today, you're seeing that a lot of these opportunities that people were hoping would come along are not coming along. So I'm going to pat ourselves on the back here and say that we actually swam a little bit upstream and went in and did deals at the end of last year and the start of this year. And that seemed to be a very, very good move, because the market, as far as I can see, is already starting to pick back up again. And I mean, light at the end of the tunnel, vaccines, whatever it is, but I even had a large Spanish company this morning say to me that they're taking their assets off the market because they believe that things are going to get better and they no longer feel like selling. So I definitely see a trend towards uplift already, positive trend, which is great for owners, but maybe not as good for the people waiting for getting a really good deal. You know, they maybe waited too long. So let's see.
Thanks, Jeremy. So George, does that mean that if somebody is expecting to find a lot of distressed inventory on the market, they have already missed the boat, or is there still much distress around?
Look, I don't think there will be the distress or the heavy level of discounting that everyone assumed, because fundamentally we are all in a health and safety pandemic where a lot different to 2008. We were in a position where there wasn't any liquidity in the market, which caused the deep discounting. But fundamentally today we're in a position where there's such a heavy weight of capital out there, and if you look right across the board, whether it's residential, healthcare, student, trying to find any real yield or value today is extremely hard. So I just think the deep discounts that everyone was hoping for, as we get closer now to reopening hotels, businesses starting back up, they're becoming more and more unrealistic. We're just around the corner now from opening back up, and you can almost see the assets that have been on the market and the sorts of prices that have been achieved. It just shows you that we're in a lot different position to what I think everyone thought.
Giovanni, does that tally with what you think? And do you think any lack of discount is to do with the amount of competition out there, or market fundamentals, or a bit of both?
Yeah, definitely a bit of both. I think there's also an element of other asset classes, real estate asset classes, having become slightly less attractive. Thinking retail and office in the long term have probably become less attractive because of macro trends. At the same time, there's a lot of capital out there, massive amount of capital out there, and I totally agree with George. And the issue is related to COVID and the current situation, and I think the long-term prospects of the hospitality industry are still strong and good. It's about the next couple of years, and obviously that needs to be factored in. But with the amount of capital out there, I'm not sure it's always getting factored in at the moment. And the assets that we've seen trading were assets that were in difficult situations before, or were highly levered, or we've seen a few assets, kind of the trophy type, thinking Beau Rivage in Geneva, or La Minerva in Rome that traded very recently, assets that have been in the families for a long time, and they were in a situation where they had to sell, but ultimately it sold, but at almost pre-COVID pricing levels.
Yeah.
Thanks, Giovanni. Andrew, can you give us some idea of the sheer amount of dry powder out there and just how competitive it is to buy an attractive asset?
Yeah, look, there's billions and billions, and you know, in the last 6 months, there's been new funds that have been set up just to focus on European hospitality of at least $1 billion. There's huge amounts of dry powder. I mean, let's look to see what sort of assets are going to come on the market. I really, you know, for 6-9 months, it's been pretty obvious there wouldn't be a lot of distressed around, quite frankly. And if I had £1 for every time a private equity company told me they wanted to buy trophy assets at a 30% discount, I would be a very wealthy guy right now. And there was smoking dope then and the smoking dope now. And the reality is that it depends how you define value, George, right? I mean, if you want, as a traditional, you talk to any private equity company, let's say they want late teens returns and blah, blah, blah. Well, BFD, I want to play cricket for England, but that's not going to happen, right? Interest rates have come down in the last 2 years by 50 basis points. You have masses more capital, huge quantities of easing. There's not a lot of distress because bank capital is double what it was 10 years ago. You know, you've got a surplus of capital. The sort of assets coming on the market, in my view, are going to be basically retirement sales, right? So guys, you don't want to spend the next 3 years getting profitability back up to 2019 levels. And these guys will accept a bit of a discount, but not a lot of a discount. And I suspect at the end of the day, when a process has taken place, there's not going to be any discount on 2019. So the answer to your question, George, is there's lots of value there, providing the key buyers understand that returns have come in because interest rates have come in, and there's masses of liquidity there. Providing expectations are fine-tuned to the returns available, which are still very attractive, right? Then I think there's going to be a lot of transactions. The other point I would make, not to dwell too much on this, but the trends that existed 2019 are going to be mostly the trends that exist 2021 and beyond. If it was a good business then, it's a good business now. There's always exceptions, right? And I think we can get really sidetracked on the pandemic. I mean, the pandemic was a natural catastrophe, and there will be some long-term changes. I actually don't think there's going to be a lot of long-term changes in trends.
Thanks, Andrew. Jeff, does that tally with your experience? Are you finding?
Absolutely. Andrew, I'm like, thank you. That's all I can say. Oh, cool, no problem.
No, but it's like, as you can imagine, when you deal with LPs on a daily basis, which we do, there's always that sentiment. It has been that sentiment that there's this expectation that there's these crazy COVID prices or something, and you have to educate them. You have to constantly tell them, and it can be frustrating because when people are sitting at home in their apartments or houses and feeling depressed because they can't travel, reading the media, they think that owning a hotel must be hell. But the remarkable thing is the amount of hotel owners I've actually met, and they've said that, you know what, it's all right, it's fine. You know, it's like I wasn't actually doing even that well in 2019. Now I can continue to actually not do too well because I just borrowed $5 million from the government with no interest. So I think, again, it's exactly right what Andrew said, that there were businesses that were not doing well in 2019, that were poorly performing, were positioned incorrectly, and were there for the taking, you might say. You know, they just needed a little bit of a push. And so that's what we've actually been able to do. We've been able to find these businesses and go in and go, you know what, we can reposition this. We can come in, we can spend the CapEx. We know, again, what Andrew said, the trends in 2019 are the same. People want quality, they want sustainability, they want a lifestyle hotel, they want a certain standard. They don't want to be crammed into a little box and with another 300,000 people on the beach. You know, it's like, what is valuable then is valuable today. So what is happening is that some opportunities have arisen, maybe weren't there in 2019 because these people were asking for stupid prices. But in the middle of COVID, they were actually able to be persuaded with offering a okay price. You know what I mean? So I think what happened is we've been able to get some really good assets at a reasonable or okay price, not this bargain basement price.
Yeah,
Can I just make one more point? Sorry.
And Andrew, go ahead. Go ahead.
Yeah, thanks. No, it's just another thing I've noticed actually. Jeff, you and I have never met, but we're clearly on the same page with all this stuff. But you know, the other thing I've noticed is actually there's a very solid argument that hospitality is going to emerge from this in a better place, because many companies have used last year to make the efficiency gains they should have made several years ago. Right? I mean, you know, if you read the quarterly results of all the big companies, the big hotel companies, often they refer to cost savings of 5% permanent, right? Using Bluetooth check-in, using less people at reception. Actually, these were trends that were happening in any place. It's just been accelerated by the insanity of the last 12 months. So you could argue that actually returns on capital, margins, break-even ADR, break-even RevPARs actually are going to be much more attractive in the future than the past because they've made all these cost savings.
Yes, and CapEx. They've had time to spend on CapEx whilst the businesses have been shut.
Yeah, and
sorry, George.
Just to add to that, I think, you know, let's take note of where we've been the last 12 months, right? It's, you know, fundamentally there has been that we've learned there's a huge change in how we shop, how we can work. You know, we've now got used to online shopping, we've got used to working from home. So, you know, I think long term there's going to be a huge behavior change in how retail is used, in how offices are used. But fundamentally, no one in any tech era is ever going to convince me that we're going to be able to travel or enjoy experiences differently, because, you know, now more than ever, people want to get out, they want to have experiential led travel, you know, and that's something that tech will never give you. So, you know, the amount of pent up demand today of people that just want to get out and be able to get on a plane and travel and, you know, be able to have these experiences is the most I think it's ever been. So I think, you know, the pickup is going to be extremely fast. And, you know, on one hand, where we talk about distressed assets and how that looks, I think we need to look at the opposite side of the coin and say, actually, through this, best in class assets, you know, on very long, secure income, if anything, those yields are going to sharpen. You know, I take, for example, our Delata that we bought with, you know, Gerard Nolan, you know, a year and a half back. You know, that's an asset which is, you know, it's 30 years leased to Delata. Delata raised money through COVID. Delata are in a position where they've paid every single rent payment, acted absolutely stellar throughout the whole process. You know, and there's an argument that yield is sharpened today. Because where can you get, you know, 29, 30 years money with a covenant that has been, you know, raised money and performed impeccably? So, you know, on the other side, I think there's a lot of assets which are best in class assets, which actually are worth more.
Yeah, thanks, George.
Yeah.
Jeff, can I just come back to you quickly? The assets that you have been looking at and that you're transacting on, have you had to compete with other funds for those? Has that been driving the price up because there is so much dry powder waiting to be deployed?
For me?
Yeah.
I would say that we have on purpose tried to look for opportunities that maybe weren't as cookie cutter as for other funds. Most funds actually do prefer to find a very simple solution where they go, okay, a little bit like what George, you just said, most people do prefer, I want a long-term lease, very secure. I want this to be, you know, central city. And we've actually come in as we're a full stack solution where we have our own brand. We're able to come in and actually have more of an impact on the operating revenue of the hotel. And so we've actually been able to come in and look at some of these assets and go, you know what, we believe, for example, one of the trends is F&B. We believe that there is a higher revenue to be earned on food and beverages, which has been proven with multiple brands, especially in New York over the past 5 years. We believe in that. We also have seen with COVID, people, if you even can stop international travel, you still have regional. You also have locals wanting to use the hotel, food and beverage, you know. So we're able to come in and say, you know what, this hotel, we could probably offer a little bit more per key because we see the square meterage and say we can exploit the square meterage in a way most of the brands can't do. And we're able to be more flexible and understanding with the HMA because we're saying, you know what, we'll let that HMA grow into the future. We won't put too much of stress on the owner with a heavy lease at the minute now and allow that growth to happen in the future. So, you know, we're able to, we're nearly allowed cheating the system a little bit by being the owner and the operator at the same time.
Okay, thanks, Jeff. Let's talk about some of the most notable transactions that have happened over the past year and perhaps some that are likely to happen shortly. Jeremy, I'll come to you first on this one. Do you want to give us a kind of a top line overview?
Yeah, I guess, George, there's a notable absence of notable transactions, I suppose, is the first observation. We can pick up notable trends, which the panel's really covered so far, which is there hasn't been a huge attrition of value on the transactions to date. We measured it at about 7.5% across 20. And to Andrew's point, where you've got the retirement or the death or the divorce circumstances, where we've brought assets to market, we've got value. And we can measure the loss of value because on some transactions, we agreed them pre-pandemic, February, March 20. Yes, they've taken longer, but probably along the way, we may have only lost about 5% of value. And that's on real opportunities like the Holiday Inn Express in Ealing, which we sold. So that's the first trend is this 20-30% reductions that people were throwing around at the start of the process to continue the theme aren't there and won't be there. But I guess what everybody's watching for, George, really closely is what's going to be the outcome of these transactions in the market at the moment. We all saw yesterday in the press about Q hotels coming to market. That looks like a really accelerated process. It'd be great to see what the sort of metrics are there as well, because in some circumstances, lenders, rather than take a bath on a situation, they've decided to take the assets in. Sharings was an example of that, the administration early into last year. And that's probably a great way of protecting value. So I think we're waiting for the notable transactions yet, outside of the ones Giovanni mentioned across Europe.
Thank you. Andrew, what's your take on that?
Yeah, I mean, I would agree with that. I mean, I think that there are sort of 4 transactions I would highlight that have happened in the last 6 months or so that I think are pretty important. There was a Starwood acquisition of the Skjøt Petri Hotel in Copenhagen, which is very important. We do a lot of business up in Scandinavia, and there's really been a dearth of major sort of international funds up there. And they've used that as an opportunity to team up with Strawberry Group, which is Nordic Choice, and they certainly intend to expand a lot. So I think that's really important. Starwood are amongst the most forward-looking, I find, of all the big funds. I think the Aberdeen Standard acquisition of the Room 2 property in Southampton is incredibly important. It validates the apart hotel model. It was the same pricing as pre-COVID, sub 5%, 25-year index link. I think it's a great deal. And I know, congratulations to the Room 2 guys who I've already congratulated, but publicly, I think they've done a very good job. I think the KSL acquisition of Sunts Resorts in Croatia is very important. I think resorts are going to be big. They should have been big in the last 5 years because they're a great asset if you know how to invest in them and run them, and that was a competitive process. And of course, Blackstone and Bourne Leisure, really, really interesting, not least because of the 1.8 billion syndicated debt offering that Starwood did to fund it. So I think there's some very interesting transactions. I completely agree with Jeremy. We've got 3 big portfolios in the market right now. The Horizon was on the market, 2-3 years ago, Jeremy? I can't remember. That's sort of come back again. And it'd be really interesting. And they've all got issues in one form or another. And it'd be really interesting to see what happens with those.
Thanks, Andrew. Brings us nicely onto the next point. We've seen extended stay and apart hotel really shine throughout the pandemic. And there's also a lot of talk around resorts too. So which types of property, by and large, have become more or less attractive during the pandemic? Giovanni, would you like to kick us off with that?
I must say I agree with Andrew in terms of leisure and in terms of leisure hotels kind of being a great buy, I think, for the next few years. I think cities that have a strong leisure component will also come out of the current situation early, because as George was saying earlier, there's a lot of pent-up demand. People want to get out and travel. In terms of resorts, I think it's not the huge boxes, 300, 400, 500 bedroom hotels, but it's more the smaller assets, less dense, you know, ideally with cottages, plunge pools, kind of separated villas, etc., etc. And ultimately, I think, you know, well-located city hotels are always a great buy. And, you know, some situations might allow for purchases of assets that were not on the market before, not necessarily at big discounts, but the availability of certain type of opportunities as shown by, you know, Starwood Capital's transaction in Copenhagen, for instance. Those assets were just not on the market before. They are on the market, or there are a few opportunities on the market now, and those are great buys, I think, overall. Yeah.
Thank you, Giovanni. George, are there any asset classes that you are looking at differently as a result of the last year? Some perhaps more attractive, some less attractive?
Look, we look right across the board, you know, because fundamentally for us, whether it's, you know, a hotel, an apartment block, an office, it's, you know, it's all real estate, and ultimately it's about what the repurposing, what the turnaround opportunity is. But I think there is, you know, there will be opportunity in the office space to convert to hotel. You know, if you can find the right central London assets on a subject to planning basis, you know, I just think that there's so much opportunity now with brands. You know, you look at the top, you know, three or four hotel companies, they've, you know, got 50 or 60 brands now between them. So, you know, there's a huge opportunity to roll out some really interesting brands. And fundamentally, it's just about how you can repurpose, you know, some of these office spaces that might not be in vogue over the next 18 months, 2 years, really.
Thanks, George. Yeah, we'll move on to the repurposing piece later, actually, because I think that is an interesting one. Jeremy, are you seeing any trends in people looking for specific types of asset classes? Is the extended stay element trickling through and becoming more attractive?
I think it is, George. And to George's point there, we are coming across a lot of these owner-operated classic London hotels, 3 or 4 buildings in the Terrace, Paddington, Earl's Court, Pimlico, which are going to lend themselves to a conversion of an extended stay model. There are a lot of independent owner-operators in London around the big stations who won't be reopening as they closed. The next generation isn't coming into the business with them. Therefore, we're working with them to repurpose those properties. And there's going to be an awful lot of that. There are going to be the redundant secondary, tertiary city hotels, which will find a completely new use along residential or care. Huge competition in the care market. It's a needs-based sector. And that's going to sweep up a lot of the redundant hotel stock and put it to good use. And yes, absolutely, redundant offices conversion.
Okay, well, let's stay on that point for a moment then. Are hospitality investors currently buying up other asset classes to convert? Is the process already starting?
Definitely, subject to planning on a conditional basis. Yes, it's happening. All the brands have got a great suite of options in the space, and we're seeing a lot of activity there.
I think that's right, actually, George. I mean, one thing that hasn't been mentioned is retail to hospitality. I think it's the House of Fraser on Oxford Street's going to become Indigo. Is that right? I read that somewhere. Anyway, there's a lot of that stuff going on. Certainly, I'm talking to a number of property people about, you know, raising capital to target retail and convert it into hospitality. I think that is going to be a big space. And I think apart hotels, the model was fantastic pre-2020. It's doubly fantastic now. High returns on capital, low operating costs. I think it's a great business. I think you're going to see a lot more of that.
What plays in favor, obviously, of conversions is also we don't really know what expects us in 2021 and 2022, and having 2-3 years of kind of like repositioning time will allow to open at kind of at the hopefully perfect time in the cycle. We're focusing on we focus on buying hotels, existing hotels, but at the moment we're looking at a lot of hotels that need kind of big capex investments and potentially not reopening them ahead of the full repositioning of the hotel. We're buying a hotel in Florence at the moment. We're not going to reopen. It's closed at the moment. We're not going to reopen it. We're going to start the renovation as soon as possible and then reopen it in 2023. And I've heard a few people. I was speaking to a friend yesterday that works for a high kind of a Middle Eastern investor, and he's saying they're closing a hotel in southern France, and they will reposition it, renovate it, and then reopen it. Hopefully, when things will be a lot better.
Yeah, thanks, Giovanni. I think to Andrew's point, I think the high street is going to look very different in a few years' time. I mean, not only have we got the hospitality conversions, we've got the likes of John Lewis converting some of its stores, and they're effectively becoming a build-to-rent landlord and a housing association, in fact. So, the blurring of the lines is continuing at pace, I think. What do we think about the number of operators that are likely to change hands? We're not, as well as assets, are there going to be a lot of operators coming on the market? Andrew, do you want to give us your opinion on that?
Yeah, definitely. I mean, I think the trends we saw pre-2020 where, real estate owners were buying operators. We saw that with Schroders and Algonquin, and we saw that with Frio, Michel's and Taylor. That was actually our deal, and we saw that with Hamilton being sold to Pyramid, etc. I mean, all that stuff is going to be accelerated, and we saw Activum buy Odyssey last year. We're certainly very much involved advising operators right now in terms of engagements we have to sell them. So, and I think the rationale is very simple, right? If returns have reduced, which they have done in the last few years, pursuant to what we were talking about earlier, then as real estate owners, you're going to try and extract more value from the real estate you buy. How do you do that? Is you have an operator. And I think that's a fundamental trend that will accelerate in the future, driven by the events of the last year.
We've seen a fair bit of that in the service department and apart hotel space, yep, with Brookfield and Eden and so on. Do you think that will filter out to the broader hotel market too?
Yeah, absolutely. I think it already has, George, and I think it will continue. That trend will continue to accelerate. Really do.
And Jeff, I guess that is essentially your business model too.
Yeah, I'm fully supportive of again what Andrew is saying. I seem to be always agreeing, but when we started because of the reason that we understood that there was, well, again, we're very new. So we started in 2018. And so we're one of those guys who've started basically when it was probably the most difficult, 2018, 2019, to extract any yield. It was like, that was like where, how do you extract yield? And we found out that the real way was getting in there and being a part of the operation itself. Because it is operational excellence, you can actually squeeze that lemon a lot more. So we found that we were able to extract a lot more or a lot higher yields by being totally involved in the whole process. The only thing that's happened actually, which is a bit of a, we couldn't plan for a pandemic, but by having a pandemic coming along, we realized also that it's an advantage when you actually are the operator as well, because you could leverage both government assistance and also be more giving with each entity or each operation of that asset, because you control it. So, you can ease off one level, you could enforce one other level. So and then you could spend the time more closely doing the capex or the renovation or the repositioning because of you have the control. So I'm sorry to say this, but it's like, I think it's not as hard as some people think it is to operate a hotel. Building a brand is difficult. That takes a lot of effort, a lot of decision, creativity, etc. But operating is really, like a lot of things, it's process. So yeah, I don't think that there's any reason why most owners now can't operate the hotel themselves, and maybe work with the brand to sit on top, or even maybe develop their own, because there's a lot of options out there. And I think the consumer now expects a lot of options. They don't just always expect a cookie cutter solution. They do want to try different things.
George, as an owner, do you operate any of your own hotels? And if you don't, is it something that you would consider in the future?
Yeah, look, it's definitely now within the new platform, it's something we're looking at. Obviously, you know, in a past life, everything we did, you know, we were laser focused on creating value through development, and we didn't really pay much attention in the early days to the operation. But I think as as times have moved on and margins have been squeezed, and you know, there's so much more liquidity in the market. You know, you have to be an operator today, and you know exactly what Jeff said. It's, you know, operating isn't actually difficult because it is process. What is really difficult is creating a brand, right? So it's, you know, definitely along with our partners in the new assets we're looking at, we're taking a very active role in driving value through asset management and operating as well.
Thanks, George. What about lenders? How have their attitudes changed towards financing hospitality acquisitions over the last year or so, and how do you think it might change going forward? Jeremy, would you like to kick off with that one?
Yeah, I mean, if you speak to any of the main high street lenders, they spent the whole of 2020 working on their loan book, processing the CBILS loans and other assistance to keep the business going. And that was just to keep it on the road. So they won't have come up for air, they would say, until probably late into 2020. Now they're coming through the other side. They can see the road path to reopening. So they're there to help the customers again in respect of reopening and the working capital requirements that will be needed in many of these businesses outside of coast and country leisure. In the corporate market, there will still be, there'll still need to be a lot of assistance as the government assistance erodes. So they're coming out the other side, the lenders. Are they looking to make new friends? Are they looking to find new customers? Not that many in respect to the traditional high street 4 or 5 lenders. We've seen lots of activity from out north. They're great. They come in, they challenge, they recapitalize, they step in. But we would hope at the moment, we've had a functioning market really without lenders being active. So we would hope coming through the other end, and we are hearing, George, hints from them that they will now look at situations. Out North or Synergy or Metro are now telling us, as will the other lenders, they will start looking at opportunities. But I think we've got to get on the road post full opening in May for that to develop.
I'm just going to jump in there and say, because I deal with the banks, you know, nearly daily, and yeah, like I said, last year they basically were. They didn't even want to, like, they would laugh at you openly if you asked for financing for, especially an acquisition in a hotel. Whereas today it is completely different. They actively will call me now and say, you know, are you looking to buy some more, Jeff? Because we're here, you know. And the biggest reason for that is in most markets, there are so many European-wide schemes and guarantees being offered to the banks that they are actually they have such limited risk that why not, you know? And it's also because 2020 was such a downward year for them. Now they're saying, okay, let's get back to making some money again themselves. So again, an acquisition just recently we're doing, the bank was, of course, will help you with that, because they said 90% will be guaranteed by the state. And so they're a little bit like, why not? And I will say too, they're using the opportunity to make money as well, because they do offer you some very interesting interest rates compared to what, you know, they're paying. because they're trying to tell you that they're taking this risk. So they're there, and it's just a very, very creative marketing.
Andrew, you look like you might have something to say about that.
Well, George, I've always got something to say about these things, as you know. I mean, look, there are two types of lender. There's those who look back and those who look forward, right? And the big commercial banks have looked back all the time. And right now, I'm in conversations with some very senior bankers right now, and it's sort of, oh no, we're going to wait until, we're going to take the May opening, and there's been a couple of months of trade. But, if you started a process now, you've got credit approval next week. It's going to be 3 months until you sign on the dotted line. Right? So what is the problem now in actually getting credit approved term sheets now? And then you got ones that look forward, and Jeremy mentioned some of them, and these guys are very aggressive. They have put stuff on hold in the last few months, apart from Oak North, but they're absolutely ready right now, or it looks as if they're ready right now to start getting credit approved commitments in the full knowledge that the deal will not be signed by the money will not transfer by mid-May, and they've always got the option, if catastrophe happens again, to pull out. That's how these guys gain market share versus the big guys who are all focused on their own books. There's no senior bankers on the call today. I apologise if there are.
I'm a bit worried there might be operators on the call as well, because we've all told them that their job is easy too.
Right.
Andrew, looking forward in terms of major M&A activity, can you see any big deals between the major hotel groups on the horizon? They're always talked about, but do you think any of them will happen?
Yeah, I do. And the reason why is because ultimately the determination of transaction activity is liquidity. And there's masses of it around. Right, and there's a lot of strategic reasons why Hyatt will want to buy something in Europe, and all this sort of stuff. So I absolutely think that I think it's a general consensus that transaction activity will pick up. We're already seeing it in our business. We're a tiny business. I'm seeing a lot of conversations that we've been having over the last 6-9 months. Really accelerate in terms of transactional stuff.
I'm going to throw in another football analogy, because I always liken these deals to transfer fees. And anytime you hit a milestone like the first £1 million player or £10 million player, everybody thinks it's crazy and you shouldn't be paying these prices. But when you look back on them in hindsight, they seem like peanuts. And I think that is quite often the case on these major M&A deals. We are going to take some questions.
The golden rule on that is that deals happen when buyers think it's cheap and sellers think it's expensive.
Yeah, and look, it's classic private equity, isn't it? It's just the art of consolidation, really, and gaining market share with most of these guys. That's what it's all about. But that's why, if we look back across the last 10 years and what operators have grown, I think the important thing to look at is how have they grown. So, you take the likes of Hilton. Hilton have really built those brands organically on management contracts, which, as we all know, is the hardest business to get. Not signing any leases, no mergers and acquisitions, just by the pure strength of that brand, where there's so many of the other guys, they're buying each other out, there's mergers and acquisitions everywhere, and, signing leases to gain market share and so on. So I think what we will see across the next 12 to 18 months is, from an operator's perspective, it will be a case of winners and losers, because you cannot cut corners today from an operating perspective, and the best operators will survive, and some of the others won't.
Yeah, thanks, George. We've got a question here from Macy Marvel, who says, given the strong rise in long-term bond yields, are property yields going up? Who would like to have a go at that one?
I will.
Go for it.
As you will see from the latest AHV monthly newsletter, right, which analyses movements in capital markets, you may see long-term bond yields have gone up, but spreads have declined. So actually, the absolute corporate borrowing rate is about the same as it was. So my answer to the question is no. How about that?
Going back to the banks briefly, Gerard Nolan is asking, are the main bank, we've touched on this to an extent, but we can go into a touch more detail here. Are the main banks lending on hotels, and what is the panel's experience of such loans?
From the agent's point of view, George, we are at the moment still prejudiced against anything that needs debt in respect of a bid or an offer from somebody. So if we saw an offer that came in conditional on finance, we'd be very nervous at the moment.
Anybody else like to pick up on that one?
I would just add, in one of our transactions, it's, you know, we have a little bit like what Andrew said before, which was that we have the same thing, meaning one of the banks was like, okay, this transaction is actually settling like in July, we're in, because we're going to sign it in July, and they can pull out if they want. But right now they're saying they're in. So it shows a little bit the attitude now.
Yeah, okay. Right, well, I am going to be uncharacteristically generous now and give you all a virtual £100 million to go out and spend on hospitality assets. You have to start the search next week. So I want to ask you all in turn what you would look to buy. And I'm going to start with you, please, George.
So look, I think right across the board, you know, you need to be ultra opportunistic, and you need to be crystal clear on how you're adding value and what that time horizon looks like. You know, is it in the planning? Is it in the development, the asset management, the financial engineering? So, you know, I would look at, you know, a variety of subject to planning deals, you know, change of use, office to hotel. If I could buy, you know, I know conference hotels are not necessarily in vogue now because there's a lot of people with the opinion of when will, you know, the business traveller come back. So it's how can you repurpose those spaces into more co-working spaces within a hotel where people would have, you know, they don't necessarily need to be in a co-working building, but they can be in a hotel and have all the great facilities of a hotel. So, you know, there's many different ideas of things we're looking at. And also I think there's a huge opportunity in, you know, the food and beverage space in the respect of, you know, I think landlords today are now negotiating, saying, well, we know we won't get a 10-year lease on our space anymore. And you know, we're happy to put capex in. We're happy to talk about 12 to 18 months rent freeze. We're happy to look at turnover leases. So I think that there's a huge opportunity in the food and beverage space as well. And we've now created a separate vehicle called Argo Ventures, which is me and Anu Badola. So we're looking at, you know, 4 or 5 different opportunities with different food and beverage partners today to roll out a platform there as well. So yeah, that's what we're concentrating on.
Thanks, George. Jeremy, over to you.
I would probably take advantage of the built and trading stock in the market at the moment that can be bought. I think in good commercial locations with long-term positive fundamentals, I think you can buy at a good discount to replacement. And they're sitting well to benefit from the upturn that's coming our way. A number of Holiday Inn Express opportunities, latest brand standards. So I think I'd probably, George, get in there and see what we could buy. I think it's interesting what George says about the food and beverage side. That needs to be evolved even within the branded properties. We did a deal for Yum Brands recently where we sold an established hotel group lots of Pizza Hut delivery units, which they're going to run through the hotels as well. So I think I would buy established businesses up and trading, and I'd buy myself a good management platform as well.
Thank you, Jeremy. Andrew.
Yeah, I'd divide it into 2 actually, George. I think I'd spend 50 million on, this is very controversial, big city conference hotels. Absolutely, because I think they're going to come back with a bang. I think it's fashionable to think conferences are a thing of the past. Nonsense. They are not. They're going to come back bigger and better. And
Amen to that.
Yeah, I think that if there is value to be had in terms of discounts on 2019 values, it's going to be in those hotels. The other 50 million, I would undoubtedly invest in development of apart hotels.
Great. Thanks, Andrew. Giovanni.
Well, we are in the process of buying a small med resort platform. So I think I'd definitely spend some money on that. And then well-located city hotels, I think, you know, especially in cities like Barcelona, Amsterdam, or Venice, as I mentioned before, kind of leisure-skewed markets could be interesting over the next couple of years. And I mentioned these cities because they have very high barriers to entry, and they even have moratoriums in the respective cities on new hotels. So I think that, you know, that Amsterdam is very tough, right? Everyone likes Amsterdam, everyone wants to be in Amsterdam, but we bought a hotel pre-COVID, the Lloyd Hotel in Amsterdam, and we're super happy about it. It was, you know, EBITDA positive last year, which is amazing, but that was thanks to government support, Booking.com offices around the corner. Yeah, I think still well-located city hotels with a strong leisure component, and then med resorts, I think, have a future. Not the big boxes on the beach, I think, but the smaller 150, 200 bedroom hotels max.
Thanks, Giovanni. And finally, Jeff.
Well, I can tell you exactly what I am doing, and so it's not really a hypothetical, and that is targeting poorly positioned or fatigued hotels that still have an interesting attribute, you know, be it something with be it their location in particular, or having a rooftop or garden or something like that, but in these historically strong centers for tourism. So the obvious ones: Rome, Milan, Venice, Florence, Barcelona, Madrid, Lisbon, where you have had a downturn, and particular hotels, you know, the ones that we all know, these 4-star, 3-star family-owned hotels that have beautiful buildings but never really spent much money. We're shooting fish in a barrel when they were operating in the last 5 years because it was so easy just to fill them up with tour operator, you know, tourists. And last year that just dried up. And so, you know, you can go to them now and say, look, you know, I'll take this off your hands, generational shift or whatever you want to call it, and spend, you know, X amount of money on the CapEx, reposition it, put it back in the market, and they're going to be incredibly beautiful and desirable assets in 3 years' time. So that's what we're doing.
Thanks, Jeff. A good cross-section of answers there. Thank you ever so much, gentlemen, for all your input today. I think it's been a great discussion. I just need to quickly run through a few slides before we sign off, because we are coming up to the end of our allotted hour. The next Urban Living webinar is on March 24th, and it is titled "A Year into COVID, Investor Sentiment Revisited." So that will take a broader look at not just hospitality, but other real estate asset classes. We've got a great panel there. The details to sign up for that are in the chat on the right. As I mentioned, these webinars are a precursor to the Urban Living Festival, which is taking place in London in July. And here you can see all our fantastic sponsors and media partners. If you'd like to find out more, please do contact my colleague Katie, whose details are on the screen and also in the chat. If you are active on social media, please do get involved and follow us. We're on all the various channels. And it just leaves me to say thank you to our series sponsor, Res Harmonics. Thank you, Andrew and AHV, for sponsoring this particular session. Thank you to Jeff, to George, to Giovanni, to Jeremy, and to Andrew. Thanks to you for watching, and see you on another webinar soon. Thanks very much, everybody. Bye-bye.
Thank you. Bye.
Thanks, everyone.
Thank you, guys.